Just want to put the disclaimer out there for the topic discussion on SPY. Thanks, Steve. You
Yep.
can take it over now.
All right, let me share my screen here. And I'm going to continue on yesterday's discussion on SPY. Over here, we're going to come back to the single leg dashboard. And what we did was cover some of the analytics on single legs yesterday for SPY, and the single leg trades are those options trades that don't have a multi-leg indicator or contingent. So when options trade, if you enter an order in, for example, like a bull call spread, where you need to simultaneously get both legs filled, it enters a complex order book and it will get tagged as a multi-leg trade. Same thing with the contingent trade if you tag it contingent. These trades that we're analyzing didn't have those tags. They were just single leg orders, call or put, buy or sell, call or put. And once we isolate them and put them in a bucket, we could analyze them from different perspectives. So we went over these top row yesterday of analytics, and I think we stopped here at notable trades, which were the biggest, individual trades, not and the difference between the trades and the total volume is that you could have an option that trades a lot of volume, but that's an accumulation of many different trades throughout the day, right? So the way volume works is it starts at 9:30, and the more that trades in that option, the volume keeps increasing. The notable trades is when we spot an individual trade that entered the market and then we tag it. And we stopped there yesterday on the notable trades. So let's move on to the rest of the analysis on this page. And here, what we are shown is the breakdown of the option contracts based on the delta of the option. Okay, so why do we want to break it down? Well, we have 6 million contracts that traded in SPY. But when we think about the option contracts, 6 million, not all the options are on the same strike. So you could have strikes that are very far away. You could have strikes right at the money. You could have strikes that are closer to the money. You also, could have a big concentration of volume, let's say in upside calls, right? Or downside puts. So how do we know, where the order flow is or how people are utilizing the options? We would need to put them into buckets and get a distribution of how are people using options in SPY yesterday. And we could divide it by calls and puts. So over here, you see we have calls in the yellow, puts in the blue. And then at the time of the trade, we could tag what the delta was of the option. So if the delta of the option is low, that means it is an out of the money option. It could be a wing. If the delta of the option is close to 50 delta, that means it's an at the money option. So let's take a look at what happened yesterday. I'm going to come down here. And first we see the tails. So this is the breakdown in the tails, which are options that are really far out of the money. It gives us a low delta, meaning that if the stock is moving around at the money, if it's just bouncing around, if it's bouncing around this stock price, then these options are not expected to move a lot because the stock needs to make a major move for those options to start being sensitive to a stock move. So the tails would be something like 5 delta or lower. Okay, so think about like an option where has a low probability or low chance of going in the money, but something would really need to happen. There would have to be a bigger volatile move or big volatility event for those options to move. So we could see here that if we compare 13% of all the volume in the single leg trades were in the puts, the tail, the low delta puts. Okay. And that's compared to the calls 10%. Okay, 10% of the single leg options were in those low delta calls. Then we see the biggest volume were right around the at the money. Okay, so that at the money, it's not going to be exactly 50 delta. It can be 55, 60 delta. We give it, we give it about up to, 25 to 75 delta. So we give it a little bit of leeway there. So at the money or closer to at the money, where those options will have sensitivity to the stock moving $1, in either direction. So those options will move around as the stock's moving around. And here we see that the majority of the options that traded on this distribution were the at the money calls, 29%. So that was the most popular, option category, 29% at the money calls, and then right next to it, 27% at the money puts. And if you just combine those, you could see that the at the monies, right, would closer to 60%, a little bit below, were concentrated around at the money options, calls, inputs. Now we also have in the money options. Now the deep in the money options will move. They're very sensitive to the stock movement, almost 1-for-1. These aren't exactly 1-for-1, but I think these are like 95 deltas, 95 to 100 deltas. And here we see that not a lot of trading in there, about 1% in each. 1% in calls, 1% in puts. And then we have the wings. And the wings are options that are further away from the at the money options. So the stock does need to move quite a, at least a standard deviation or so to hit those strikes. And I believe we're, just from top of my head, they would have to be below 25 delta option up to 5 delta. And here we see that the wings, how we categorize 10% of the overall single leg options were in the puts, 9% in the calls. So these are pretty balanced out. And now we kind of have an idea how traders are utilizing the options in SPY based on this category. Okay. And the conclusions, most of it is really around the at the money, and the wings combined. Now, there are different, so let's go now over to here by trader size. And when we look at the volume, the cumulative volume, it could be a accumulation of a lot of small trades, right? A lot of maybe retail traders are sending in, buy 1 contract, buy 2 contract, buy 3 contract. But if a lot of them they could accumulate to thousands of contracts if there are a lot of people entering it in. We could also see one big trade all day. It could be 10,000 contracts. Here's one trade. Here's 7,500 contracts. That could be the whole thing. And we want to see the breakdown to get an idea, how these orders are coming in. Are there more big players, small players? Is it distributed equally? To get a sense of, the different players and the distribution of the order sizes that are coming into the market. So here's the distribution. We have 4 categories here. One is the small trader, which we look at as really anything under 10 contracts with a notional value. I believe it's under 10,000. We would just categorize as generally that's in the smaller category. If we see a little bit bigger size, but up to like 50,000 and under 50 contracts, we'll say, okay, this looks more like a retail trader, but a bigger size retail trader. So if you combine the small here in retail, it's usually, more in line with a retail size trade. Then we get into a category where the trader would have to be more proficient, in the sense that if you're going, above, like say 50 contracts at a time, about 50,000 notional value in an option contract, we categorize that as more of like a proficient trader, because it's more likely, that to get to that point, you would have to have or show that you had a lot of years of experience just for a broker to approve you to trade in that size, especially if you're selling options and buying bigger notion options. And if you're doing that size and comfortable with it, you're more in the more proficient, or call a pro for abbreviated category. Then we got the very large trader. I believe it's a notional of I gotta look this up. I should, but I believe that this would be over $100,000 in notional value, and for 500 contracts. And the idea there is that
AD?
Yeah.
Sorry about there's a little bit of a delay, but Chris was asking, do increased wing and tail activity forecast? Is there any forecast of increased future IVs? The question by Chris.
Well, we could compare what the implied volatility did, as well. We'll do that next. What was right now? We're just going over the breakdown in the volume, and then we're gonna connect that volume to how did the option how did the option prices react to it? What happened in the market? So that will be next when we come down here. Okay. And over here, I'm just going to stop. I think I started at the large trader. This would really be more in the institutional side, a much larger trade, and these trades would be big enough where that if you did a trade this size, you're pretty committed to it, because typically, it's a large trade. You may be held to that trade. It's to expiration. It's a large trade for typically what trades in the options. So that's the breakdown in the four different buckets. We try to section it off in bucket to get a quick sense of what's going on. That's what this dashboard is. Just, if you get used to looking at it, once you pop it in, or just by looking at it, you're going to get a kind of good idea how this order flow is flowing to where, who's kind of participating, where are the bigger, what are the big trades standing out, what are the most active options, and so forth. And coming down here, lastly, we look at the distribution of the volume based on the different exchanges. And here it shows that ARCA made the top of the list. Over here, 16%, EDGX, and then you could see as it goes down. And the idea there is that you want to get a sense of if a lot of the volume is concentrated on one exchange, if it's equally distributed, and think of as if you're looking to improve your execution, right? You want to get part of trading is how do I improve my execution, get a better price? And to improve your execution and get a better price, you're going to want to see, well, where are most of the order flow and trades happening? Because if a lot of trading is going on a particular exchange, it's possible that you could negotiate a better price. Maybe you could get the midpoint, maybe you could get better than the midpoint. But this will point to you where the order flow is getting transacted. And if you wanted to direct your order to a particular exchange, you have a distribution of where those trades are happening, right? So you could, try to put a limit order on the PHLX, but that same limit order maybe going to the ARCA, there could be like a hidden or invisible pump there that you may be able to transact that is not being displayed, or there are market makers or specialists there that are willing to price improve in incoming orders. So this is kind of the idea behind seeing the distribution of the order flow. Okay, now let's come down here. And there was a good question. How are the trading volume impacting the option prices? And that's the next question. We have the volume breakdown, and how are they impacting the option prices? And to do that, we could start referencing the implied volatility of the options. So if the implied volatility is going up, that means on a relative basis, they're pushing option premiums higher. If the implied volatility is going down, then on a relative basis, they're pushing down option premiums, or the markets are. So here we have a breakdown of the volume by different expirations. So we see the different expirations here from June 24th going out to 2026, June 18th, 2026. We also see these volume bars for each expiration. The yellow volume bar represents the calls. The blue volume bar represents the puts. And visually, you could see that a huge concentration of the trading volume is in the 0 DT. This is yesterday's data. We're not open yet. This is yesterday's data. Most of the volume visually looks like it was in the 0 DTs by far. Then the next day, June 25th, looks like that was the second biggest volume expiration, and then it kind of tapers off. And what we also see here, we're almost at the end, is the implied volatility term structure. Okay, so this big line here, this is showing where the implied volatility is for at-the-money options. And you're going to see green dots and red dots and black dots. What do they mean? Now here, it's hard to see, but there are two lines. One line shows where the implied volatility last was recorded. And then there's another line, a gray line, shows the previous day's implied volatility. And this finds the at the money strike, the closest actual at the money strike, and compares the strike at implied volatility to the same implied volatility on that strike. So this isn't based on delta, but strike based implied volatility change. Okay, so the difference is we could compare yesterday's 50 delta at the money to today's 50 delta at the money, but since the stock moved, you're comparing two different strikes. What we're doing here is saying, well, where's the at the money strike, the closest one? And let's say it's 525. We'll say, okay, what is the implied volatility today for that 525 strike? And what was it yesterday? And what was the change? That's what we're looking at. So the green dot represents that there is that implied volatility is higher. The red dot represents that the implied volatility is lower than the previous days. And if it's basically unchanged, you're just going to see a black dot. Okay. And that's what this line is. And this gives us an idea, well, how did the implied volatility change on these particular options? So really quickly, what do we see? That the term structure in SPY, implied volatility term structure, is sloping higher as we go out further in time. And that's what you typically see, because as we go out further in time, there's less and less certainty, more and more things can happen, unexpected events. As you go out further in time, implied volatility term structure usually looks like this, but it could get inverted or flattened out. And that will happen when there is more uncertainty in the near term. That could be because of a certain event, something coming up that could move the markets. In a stock that has earnings, you'll see this inverted, because an upcoming event we know can make the stock move violently, and then once the event is over and the stock moves, implied volatilities come back down. Here we're looking at a upward sloping term structure, and it doesn't look like it shifted that much from the previous day. Maybe a little bit, because the two lines are really, like, right now it's hard to even tell that there are two lines. But we could come down here to the table. Oh, we're right up at 9:30. Well, so I'm going to cover this tomorrow, because there's a lot of stuff to cover on this table. So
right, so this SPY table we'll put out in another video. We'll do it on the morning show tomorrow.
Yep.
We did have one last question. Maybe you can answer it tomorrow from Chris, or you do right now. It's up to you. Excuse me. Also, what is the difference between a large trader and a pro?
Yeah.
When I hit that tomorrow, you want to do that right to end this?
Yeah. I'll hit it tomorrow, but the real difference is that a large trader would, and I have to look at it, we have it, it's over 500 contracts. So in a single leg trade, it'll be over 500 contracts. And I think we have it, I forget the notional value, because we did an analysis when we tagged the notional value. I'll list it out. I forget if it was, I think, above 100,000 or 250,000. I have to take a look at the notional value, but it has to, meet one of those conditions to become a large trader. And it's typically something you would see from a trade that is more institutional, like a hedge fund, maybe a large institutional trade, or maybe it could come from one of those buy right funds, that we see. But
Well, those could be pros, right? If it is a large trade, they could be. I mean, those sound like
it
professional
depends on the
traders. So,
size of the
yeah.
trade. Yeah, it depends on the size but that basically we're bucketing the size of the trades. That's what we're doing, and then we just gave it a tag.
All right.
Yeah.
Perfect. Thanks, Steve. Thanks everyone for joining. Have a great day. Thanks again, buddy.
Thanks everyone. Stay safe out there. Have a great trading day.